the company in focus is CEAT.
Absolutely. The acquisition with regards to Camso has been completed. And that is very interesting because this is the off-tire market. That's where CEAT will actually gain access to. Overall, if you talk about the company as well, the stock has seen good gains. In fact, yesterday's session itself, the tire stocks were buzzing in trade. To discuss more, we are now joined by Arnab Banerjee, MD and CEO at CEAT. Mr. Banerjee, welcome to the show. My first question coming to you is, now that the acquisition is complete, can you elaborate on how Camso will align and accelerate CEAT's long-term vision to become a significant global player in the off-highway mobility sector?
Right. Off-highway has been the preferred segment for CEAT, right at the top of the heap as far as capital allocation goes, followed by two-wheeler, followed by four-wheeler, followed by truck bus radial, internally and externally. So Camso fits that bill. We had also been chasing the trend of premiumization in India and across the globe. That also fits the bill. And it adds significantly to our global saliency. Right now, we have about 90% of our turnover from non-India markets. This will go up significantly to 25% annualized when Camso integrates into our business, which is started.
Right, so that's with regards to the integration. Now, with the acquisition actually providing access to over 40 global OEMs, what is the strategy for converting these relationships into long-term, high-value contracts when you talk about the existing business as well?
Yeah, so our existing business is agriculture radial plus, and we have a little bit of an OTR portfolio also. Many of the OEMs are common, not all. And Camso is in the compact construction and tracks business. So there is a good complementarity in our product catalog now. And we can offer a much bigger basket of products to these OEMs. Also, the Camso brand straddles many other categories, for example, power equipment, agriculture tracks, etc., which we can access with Camso brand after 3 years when the brand rights also pass on to us. So then we will have the full Camso range plus the full CEAT range within 3 years to be able to be offered to many of the OEMs who have that kind of a requirement.
Right. And, you know, Mr. Banerjee, talking about the acquisition, it's almost valued at $225 million with $171 million worth of investments that go into Sri Lanka. If you could provide us with a detailed breakdown in terms of the total capital expenditure and how it will be funded.
So the overall deal size is about $225 million USD roughly, which has a component of land and building and the plant and machinery, which is about 88 million. Then there's some component about the brand, the IP and the intangibles. We have also got to take over the finished goods inventory. So finished good inventory will take over as and when we take over these markets. We have not paid for them right away. The brand rights will come after 3 years. So we will make those payments after 3 years. So right now about 137 million USD has been transferred as part of the deal out of the 225. And this funding will be roughly 70% debt and 30% equity. So that's how the funding will come about. And our balance sheet size and strength is strong enough internal accrual wise to be able to handle this kind of debt increase in our normal course of business. Our debt equity is currently at a very benign 0.4, which may move up to 0.65, 0.7 kind of range. Debt EBITDA is just over 1, and it could move to maybe close to 2, which is much below the ratio of 3. So I think we should be able to handle the debt in our normal course of business.
Debt to be handled. In fact, the stock is seeing some bit of a recovery from the day's lowest levels as well. Mr. Banerjee, talking about the financial impact now, how do you look at it from a top line and bottom line, perspective over the next 1 to 3 years?
So as far as top line is concerned, this is going to add about 10% to our turnover immediately. And the factory that we have acquired is operating at only 50% capacity utilization. So there is significant scope of growth from this factory alone without any significant capital investment further. And it is margin accretive. We expect once the business stabilizes in our hands, which may happen after 4 to 6 quarters from now, we expect the margins from this slice of the business to be in high teens, close to 20%. But it'll take some time for us to get used to the business, to get control over the entire operations.
Right. Now, if you could help us understand the outlook on the expected improvement on the overall margin profile of the combined entity.
So we had been operating in 12, 13 range, sometimes 11, sometimes 14 also, ballpark in that kind of an EBITDA margin range. So if this entity, along with the overall specialty business, grows in terms of saliency and operates at in high teens or 20% kind of thing, which would comprise of around 25%, 1/4 of our saliency of business, you can do the maths and calculate the impact. So it will be very positive for the overall CEAT business.
For the CEAT business. Now, Camso's business had a revenue of around $213 million in 2023. What is your revenue growth forecast for the acquired business and the plan to achieve this?
Right now, it is going to be business as usual. We are not going to make sweeping changes or rock the boat because we are in a supply and purchase agreement with Michelin, which means to ensure business continuity, we are buying a lot of semi-finished goods from Michelin in Sri Lanka. And we are also going to sell to Michelin sales team, who in turn will sell to the customers for some time. This is to ensure business continuity. As we pick on directly servicing the customer as fast as possible, the overall margin will start accruing to us. And this will take about 6 to 12 months at least to come to our fold. And the buying of raw material will stop once the plant is self-sufficient with some upstream equipments which we are going to put in place.
And how long will that take, Mr. Banerjee?
The entire thing will take about 12 to 18 months from the raw material side, and much earlier, hopefully, from the sales side.
Okay. Moving on, reports are also indicating that when you talk about the Sri Lankan operations, that will be export-led. So what are the primary markets you're targeting from these facilities, and how do the different tariff rates for exports from Sri Lanka versus India factor into your strategy?
Sri Lanka has got 20% tariff as of now, and India has got 50% tariff on OHT as of now, as we speak. The tariff on other categories, which is passenger and truck and everything, is 25% ex-India. So the business of Camso is spread geography-wise, about 35% in EU, about 60% in North America. Out of that, 40% is in US alone. So that is the main market that Camso caters to. And that US market will now have tariff of 20%, but Sri Lanka is not uncompetitive vis-a-vis other markets which have similar kind of tariffs of 20%. So it will be business as usual, and we'll be able to look for growth in all geographies ex-Sri Lanka.
All geographies ex-Sri Lanka will see growth. And taking that into consideration, how is the raw material price trend panning out currently? Because we did see some bit of an improvement, I think, from Q4 to Q1. Is the improvement further seen from Q1 to Q2, and the demand scenario seeing the way auto numbers are panning out right now?
The raw material price is trending down gradually. Q1 over Q4, as you know, was flat for CEAT. Q2 over Q1, we should see improvement in raw material prices, which should be margin accretive. And demand-wise, nothing much has changed. Two-wheeler is growing very well in replacement market as well as in OEM. Scooter especially, motorcycle also. Four-wheeler is muted, low single digit. And truck bus radial growth rate is mid-single digit, which has been continuing. So no major change in trend with the upcoming changes expected in the GST rates. I think it will give a big boost to growth rates for the tire industry as well.
Interesting. I'm coming back to the acquisition, Mr. Banerjee, because it enhances the company's off-highway tire scale, nearly doubles the OHD revenue. You're talking of an addition of nearly 15% to the overall revenues based on calendar year 23 financials. Now, if you have to look at every aspect, could the transaction potentially result in a 6% EPS accretion in FY26? Because that's what some of the reports are indicating. Would it be right to consider it?
Yeah, the turnover has since come down during the negotiation phase, and in the hands of Michelin, it has come down significantly. So the turnover accretion won't be 15%. It will be more in the range of 10 to 12, 13%. The EPS accretive nature of the business, yes, the nature of the business that we have acquired will be EBITDA accretive and hence EPS accretive. But it will take some time to stabilize. And once we start growing out of the Midigama factory in the medium term, which could be 4 to 6 quarters away, we expect the business to be margin accretive.
Right, the business will be margin accretive. The acquisition is EPS accretive as well from here on. But thank you, Mr. Banerjee, so much for joining us on the show and sharing your views.